Welcome to Listen to the Market for March 16. In this session, I want to show you how easy and how simple it is to learn the language of the market so you can listen to the market and see the message from the market. In that context, later on I'll also share with you a textbook buying opportunity that appeared on Friday of last week. So let's start with the language of the market. You're learning a new language, you're learning music if you will, and when you start out it's all a bit of a jumble. The more you apply yourself, the more you learn, the more you read, suddenly you start to see a couple of notes. After a while those notes come into context and you end up with a bit of a score. And then finally a symphony. So same too with listening to the market and reading the market. The last bar on the screen clearly is an inside bar. It's important to take the inside bar, any inside bar, and in fact any bar, in the context of where it is. So this little inside bar, smaller range. The real body is small, the real body is black, implying spinning of the wheels and a bit of a bearish bias. However, in the context of the previous bar, it's a bullish inside period. The market then decides to conform or confirm that hypothesis by rallying, breaking the high, having a higher low, larger range, so formally it's a promise of higher highs to come. Next bar itself is another promise of higher highs to come. Closing right at the highs shows that the buyers were the dominant force all the way through and there was no profit taking going into the close. So it's implying that for the next 6 hours, on the next 6 hour bar, the market will go higher. Next 6 hour bar comes along and what do we have? We have a higher high and a higher low, fulfilling the promise of higher highs to come. However, the range is smaller and the real body range is smaller. So clearly the buyers are running out of steam. The hypothesis being a potential top is in the making. Next bar comes along and reinforces that same message. Higher high, higher low, smaller range and a smaller real body. Now those of you who have used indicators such as the RSI courtesy of its formula will still be going up. On the other hand, the stochastic, courtesy of its formula, will have started to roll over. Now the same rollover potential top idea is present in the market when you have learned how to listen to the market, how to read the market. Next little bar comes along and what do we have? Another inside period. Now we have two inside periods to look at. In the context, the first one was bullish. This one is bearish. Opened at the highs, closed at the lows. Even within the small inside period, the sellers were the dominant force. Implication, we've had the top, the market wants to come down. Next bar confirms that by coming down, having a larger range, lower low, lower high, a promise of lower lows to come. Next bar as well. Lower low, lower high, much larger range, also a promise of lower lows to come. This is happening in the context of Friday a week ago. Now, going into the weekend, the brokers require a higher margin to hold the position. This is because of the extra volatility that can happen from Friday's close to Monday's open. Why not be guided by what the brokers know and look to exit your position on Friday's close or before Friday's close and reinstate it back on Monday. So going into Friday, the promise was of lower lows to come. The last 6 hour bar showed there was indecision. The first 6 hour bar of Monday of last week, provides a little dip being double inside period. Now double inside periods, little dips occur as the penultimate movement most of the time. So quite simply, it's a bearish message in this case, looking for lower lows to come to fulfill the promise of the third last bar, but that will be the final movement down. Next bar comes along and we get that lower low fulfilling the promise. It is a larger range, itself formed of being a promise of lower lows. However, in the context, it is not bearish. Next bar comes along, it's a white real body breaking above the high of the second last bar. Anyone who was short, swing traders have been taken for a ride. Anyone who had their stop above the previous black bar also would have been stopped out. This bar itself is a promise the market wants to go higher. That's fulfilled on the following bar and the following bar. However, the last bar on the screen now has a smaller range, not bullish, Translation bearish. The working hypothesis is perhaps this is purely a dead cat bounce. With apologies to cat lovers, of course. That's the working hypothesis. Let the market confirm or deny that. The bar that comes along opens unchanged. The buys push it above the previous bar's highs, at which stage at the high the sellers become the dominant force, pushing the prices back down below the open, closing below the open. It's a reversal bar. So the hypothesis has been proven that that was or is now a top. Look to do something with that. Next bar comes along and we have a promise of lower lows to come. Straightforward as that. Next bar comes along and we have a potential reversal, breaking down below, all the way down to the low. The buyers come in and bid it back up. Now this is recognized, supposed to be a bullish one. It's important to see the stats. Is it bullish? Is it bearish? And where is it happening in the context of the market? Next bar comes along is yet another inside period. So this is the 5th inside period in the bars that we've been looking at. So inside periods are quite common. They need to be seen in the context of where they are. This one is bullish by definition because it comes after the previous. So this one is bearish because it comes after the previous bullish message, which wasn't fulfilled. Market then comes down for one bar, comes down for a little bit on the following bar, and then reverses. An outside bar occurs at or before a market turn. In this case, the market's been coming down, looking for a potential low. Does the market confirm this? No, it doesn't. It goes lower yet again. So not every interpretation of a bar will be accurate. It's a matter of stepping back and taking each bar by itself. Next bar comes along, period of indecision, yet another inside bar. And then the next bar, getting ahead of myself here, is yet another outside bar. Now this time the open and the close are in the middle of the range. It's a white little body. Outside bars tend to happen at or before a market turn. The market will confirm whether this is accurate. The market confirms it by rallying and providing a promise of higher highs to come. That's then fulfilled on the next bar, itself being a promise that the market still wants to go higher. So each bar has a message for the next bar. Next bar comes along, is a little inside period. Next bar comes along, and that's actually a hidden message in there whereby the market opened, rallied all the way back up, didn't break the previous bar's highs, came back down, gave you a small real body, closing above the open, and that's in fact a little retest of the previous high. Next bar comes along, confirming the retest of the previous high idea, and itself is yet another reversal where the sellers push it down, the buyers push it back up. This time it's a bullish one. Next bar comes along and promise of higher highs. So I've run through a lot of data, a lot of information, 6-hour bars, more than 1 week of price action, and perhaps you're beginning to see there is reason and rhyme behind each bar. Each bar does have a meaning and a meaning for the next bar. Now let's have a look at the setups that come along through the understanding of the price movements. The first one that was actionable was a little hip buy in through there. Then it was followed by a SIP sell. Now acronym city is important just to catalog the individual setups. Next one that came along was a little dip sell. That's where the swing traders got into the action and got stopped out on the next bar because that provided a little FO buy itself. 3 bars later, 4 bars later, we get a little Gorb sell. It's then reinforced by a little hip sell, and then we go down for a fake out buy, an FO buy that doesn't go anywhere. Got to have some losing trades. Another fake out buy. This time it leads to a nice little campaign at the top side. RTV sell followed by an RT buy. So you can see how the L.I.V.E setups tend to occur pretty close to turning points. Is it 100% accurate? Nothing is. So I've given you a bit of an insight into my world of listening to the market and reading the language of the market. Let's now have a look at the top-down approach for Friday of last week. 60-minute chart, 30-minute chart, and 15-minute charts all had buy setups on the same time in the idealized window. The message for the Friday was for a smaller range and that the market favored sells. The 60-minute buy was a Gorb buy, the 30-minute buy was a FO2R buy, and the 15-minute one was a 3MT BEB buy. Now, smaller range implies that we're not looking to roll up, and what Friday gave was that the range on the 15, the 30, and the 60 were virtually identical in size. Translation: you take the buying setup on the largest time frame. Take it on the 60-minute one. So in terms of doing that, quite simply, you have the entry marked and the exit marked up near the top. On the basis of a simple regular entry mechanism, there was 21 pips of risk. What was on offer in terms of pips was about 100 pips, which gives you a 5R return. On the other hand, those who are privy to knowing the enhanced entry mechanism, the same 100 pips on offer produced about a 10R return. So what I've done in this video is walk you through some of the language of the market, as well as the setups that come from the language of the market, and then finally the textbook opportunity from last Friday. So thank you for watching, one and all. Catch you next time round. Bye for now.